SpaceX went public on June 12, 2026, carrying a roughly $1.94 trillion market value. And yet, one of the biggest pillars of its growth story, Grok, is already moving in the wrong direction. Grok's monthly active users are down 5% quarter over quarter in Q2 2026 so far, while SpaceX is asking investors to believe AI can become its next monster business. Because SpaceX isn't just rockets and Starlink anymore. After bringing XAI and Grok under the same roof, investors are effectively buying a space company, a satellite internet company, and an expensive AI moonshot in one very large, very shiny package. And when one of those engines starts coughing, Wall Street notices. The awkward part? Grok previously reached 17.8% US chatbot market share in January 2026, good enough for third place behind ChatGPT and Gemini. So this isn't a story about a product nobody ever used. It's a story about whether Grok can hold attention after the initial hype wears off. This video breaks down whether Grok's slide is a temporary wobble or a warning that SpaceX stock is priced for an AI future that may not arrive on schedule. This video expands on my recent article for Barchart. The link to read it fully is in the description. If you're into stocks and markets, hit that like button and subscribe for more breakdowns like this. Let's get into it. The number that actually matters is -5%. Grok's monthly active users dropped 5% quarter over quarter in Q2 2026 so far. App downloads fell 22% year over year in the April to May stretch. Weekly active users were already down 10% from March to April. While every rival kept adding users, Grok went the other direction. As of March 2026, SpaceX reported 117 million monthly active users of Grok AI features. That same ecosystem had 550 million combined monthly active users across Grok and X. Only about 1 in 5 people in the broader platform was actually using Grok. That's the engagement problem staring investors in the face. What does that actually mean for investors? Fewer engaged users make it harder to monetize tokens, build switching costs, or justify the heavy infrastructure spend. Yet, that's exactly what SpaceX has been doing. They bought XA for $250 billion in February 2026. In 2025 alone, they spent $13 billion on chips and data centers. That spending helped turn $18.5 billion in revenue into a nearly $5 billion net loss. AI is expensive and the returns are backloaded. But the user trend is moving in the wrong direction right now. That directly pressures the growth assumptions they sold to public market investors. The valuation doesn't care about excuses. SpaceX stock trades at 104.66 times sales. The shares debuted at $150 in June 2026, spiked toward $225, and now sit around $140 to $145 as of July 14th. Already down 4.5% in the latest session and roughly 8% year to date. The market is already applying skepticism to the AI growth story, and that takes us straight into how SpaceX is actually responding. The company launched Grok 4.5 in early July 2026 as its biggest release yet, complete with published enterprise token pricing. At the same time, it rolled out a no-code voice agent builder powered by Grok Voice. That matters because it opens a more practical commercial path than baiting everything on chatbot subscriptions. Customer support, sales teams, and call centers already have real budgets. It's a strategically sensible move to turn Grok into something companies can actually pay for and deploy quickly. The catch, of course, is execution. On the infrastructure side, SpaceX has Colossus and Colossus 2 data centers that together provide about 1 gigawatt of compute capacity dedicated to Grok training and inference. The stated goal is to scale next generation models to multiple trillions of parameters. That's the scale they believe is needed to close the performance and adoption gap. the bull case in one sentence, SpaceX could end up with a uniquely integrated AI stack: distribution through X, connectivity through Starlink, massive on-prem compute, and eventually the possibility of space-based computing assets. 30 Wall Street firms now cover SpaceX. The consensus is moderate buy, with an average 12-month price target at $217. That's roughly a 41% upside from current levels around $140 to $145. Adam Jonas of Morgan Stanley floated a $300 target for SPCX, implying about 102% upside. Raymond James went even bigger with an $800 target, implying about 439% upside. But it's not all champagne and roses. A couple of firms, CFRA with a $115 target and Morningstar with $63, are much more skeptical and have sell ratings. They're worried about the sky-high valuation and whether Grok can actually deliver the growth that justified the IPO price. That split in views sets up the real decision for investors. My balanced view: SpaceX's AI strategy is not already in trouble, but it is officially on the clock. I treat Grok's next user, revenue, and margin data as more important than another flashy model announcement. If you already own shares, the position is fine, but size it appropriately. If you're looking to start one, I'd wait for either a pullback toward $130 or hard proof of a user growth rebound before committing fresh capital. This is not financial advice. Always do your own research before buying any stock. Past performance does not guarantee future results. If this helped, smash the like button, subscribe, and turn on notifications. Drop a comment. What do you think about SPCX? Is Grok a short-term speed bump or the weak link in SpaceX's trillion-dollar growth story? Which stock should I cover next? I will see you in the next one.